There's about 3,000 companies a year. There's about probably 30 to 50,000 looking for money. There's about 3,000 public market companies. Let's just take one, Amazon. Who went and bought Amazon in 2003 when it was $3 a share?
Some really fortunate people. Everybody, welcome back to Break Free from Wall Street, the show where we explore how investors can move beyond public markets and better understand how real capital is being deployed in private companies and alternative assets. Today, we are very grateful to be joined by John Frankel, the founder of
Welcome.
FF Venture Capital. Thank you for being here, John. FF Venture Capital, just to give people an idea, one of the earliest and, as I understand it, most active seed investors in New York's tech ecosystem. Since founding FFVC in 2008, I believe John and his team have backed over 150 early stage companies, really just helping create thousands of jobs, shaping industries from fintech to robotics and applied AI. So really grateful for your time today and the opportunity we have to hear your experience and your insight.
Not at all. Thank you. Thank you for having me on your show, and happy to answer any questions you have.
Absolutely. Yes. Thanks again. When I was looking into your background and your experience, I noticed you spent a significant part of your career at Goldman Sachs. I feel like most people see that as like the destination for their career, or envision themselves working their way to Goldman Sachs, right? Tell us a little bit about what I believe was something like 20 plus years of experience that you had with Goldman Sachs. Is that right?
Yeah, I joined them in '86 and I left in 2008, so I was there for 21 years. I did about a dozen jobs at Goldman. I joined in controllers, did spend some time in operations, prime brokerage, offshore administration, global custody, and then the last 11 years on the sales and trading floor in New York, covering hedge funds for US shares.
That's amazing. And with your time with Goldman Sachs, when you're looking at working, I feel like inside Wall Street, what did that teach you about capital, and how did that kind of frame your, you eventually moving into the more private sector?
Well, I always was an early tech adopter. In fact, I think at the age of 16, I did my first programming in BASIC. And then when I
Oh,
went to
wow.
Oxford for fun, I did some programming in a language called Pascal. Not quite sure what I did with it, but I remember learning Pascal. So I've always been a bit of an early tech adopter. When I joined Goldman, they had mainframes, and we were moving to client server. Windows first graphic user interface came out, early spreadsheet user, power user of spreadsheets, which really was a distributed form of computing. If you think about it, moved processing from the data center down to the people actually doing the work. A bit like what we're seeing today with AI, which is moving processing from core systems to where people are actually doing the work, and leading, like it did then, to reinventing how work is done. And then the internet and centralization and the like. I helped re-engineer prime brokerage, worked closely with a number of interesting tech companies at the time. And then when I moved into research sales, technology was a really big area of focus for me. I could see the inherent growth embedded in it. So I've always had an interest in that. I started angel investing in December 99 because I really wanted the growth side that you get from investing in private markets without the daily mark to market, which can drive you crazy. Yeah, I saw too many hedge fund folks whose heads were glued to a screen, and something happened in Japan overnight, and their positions would move, and they're all prematurely aged. And so I kind of had a capability for it for sure. And when I left Goldman in '08, I founded FF Venture Capital. We have, as you mentioned, we've been running in the US since '08. We've been running in Warsaw since 2019. We have 6 US funds, we have 2 European funds. And yeah, we're highly engaged investors in what we do.
That's amazing. And it sounds like that the time in Goldman Sachs gave you the perspective you needed to eventually found, this venture capital firm. Tell us more about what that looked like and how your experience at Goldman kind of played into that.
Well, so the first half of my career was helping build various businesses and working with technology folks. Research sales, which I'm not sure that job really exists today, but it was a job where you would go and listen to every research analyst Goldman had, understand what they were saying. They didn't all talk every day, but on many days they talked. And against what they were saying, you would have to understand the underlying business models, work very, very carefully with regard to that, and then be able to interpret it and communicate it rapidly to investors. And so, what's that mean? That means you need to understand in healthcare, you need to understand biotech, medical devices, drug companies, the FDA, every business model. In financial services, you need to understand insurance companies and brokerages and credit card companies and banks and the like. It meant that, I remember partway during my career, it became clear to me that steel was going to be a very important area. So I went and found the steel analyst and said, "You're going to be very popular over the next 6 to 9 months. And I'm going to take you out to meet all my clients." And, like it felt like no one had knocked on his door in about 4 years. It meant that, in energy, you had to understand natural gas versus um, coal versus oil and the like, and how all those markets work. And across every single industry, there are different business models. There are things that drive them, macro and micro factors. So it's an enormous amount of information going on every day. And that's in the US. Then you had to understand what was happening overseas. You had to synthesize all this by about 8 in the morning. And then you would call up your client roster, 80 odd people from analysts to PMs. And before the open, you should be educating them on Goldman's view and your personal view on where they could make money that day. And then it's 9:30, and that's half your day is done. So it was a crazy job, but it taught you to be able to really synthesize enormous amounts of information, understand different types of business models, how barriers to entry are made, what's successful, what isn't, and the like. And that speed of synthesis, that speed of understanding, I think has been very helpful in working with founders, understanding their business models and helping them tune them to be successful.
That sounds, to be honest, completely overwhelming. I mean, that's so many different sectors, so many different, and when you're understanding these things, at first, when I imagine it, I'm thinking like you gotta first take it as high level as you can and just soak in whatever knowledge you can, and then I guess just over time, you just start to, like you said, develop this talent to synthesize the information and understand it more quickly.
Yes, it's the definition of drinking from a fire hose, and every industry was different. There was an analyst, a great woman called Nomi Gez, and she covered companies like Heinz and the like. And if she moved her estimate 2 cents on the earnings for Heinz, the stock would move. So you need
Mm,
to know how to listen to her. And then there's a guy called Rick Sherland who covered Microsoft, and he
mhm.
would talk to Bill Gates all the time. But Rick really didn't want to be explicit in what he said because he knew he could move the stock. And so he would just make very subtle cues on how he said things. It wasn't so much the words, but the way he said them. And, the firm's clients would really want to understand the tone as much as the words. And that was the nature of the game back then. It was very much hand-to-hand combat. Analysts at Goldman could really move markets, and our clients were very interested in what they were saying. And, it was a fascinating time. But there were enormous, you got to think of every industry and every dynamic, and you had to think how interest rates might impact equities. We were equity folks. How commodities might impact equities and the like. But you had a great opportunity also to be creative. So in 2003, when SARS came along and people were worried that it wouldn't be contained, I reached out to everybody in the firm across geography and across divisions related that might have an interest in what's going on with SARS or might have a perspective on it. And I became the information clearinghouse for that. So then I put out a newsletter once a day on what was going on with SARS. And it was a job that allowed that kind of creativity. And so anything in the firm that happened, I knew first, and I became the information source for everybody else within the firm.
Wow, just really keeping your pulse on, those important news cycles and everything. That's a really interesting insight. I could talk to you all day about what you did at Goldman Sachs, but bringing it back to more with FF Venture Capital, tell us more about who you see investing with your funds today. I feel like a lot of people, many investors, even assume that these private equity funds and venture capital firms exist primarily for institutions, primarily for family offices. From your perspective, um, who do you see investing? Do you see that changing? Do you feel like there is some kind of disconnect between, the individual accredited investor and these types of funds or these types of private markets?
So the nature of this business is there are a number of active angels in the space. Angels are people who make investment in private companies themselves. They may cut 25,000, 50, 100, $250,000 into companies, and they build a large portfolio of companies over time. So they're definitely angels. They tend to dominate at the earlier stages where those checks are more important to the companies and their later stages. And then the companies carry on growing privately, and then at some point they exit. At some point they probably go public. If they don't, they may become a liquid secondary market. There are certainly in certain names there's secondary markets that exist. They tend to be the largest of the private companies that have a consumer-facing dynamic to what they're doing. But generally, these are very illiquid investments. So they're only suitable for people who are saying, I'm willing to tie my capital up for 5, 10, 15 years. So why on earth would people want to tie their capital up for that period? Because they can get into themes and exposures that are not well expressed in the public markets, and where the nature of the investment, if it works, will compound at strong double-digit rates, which means when you're successful, you make 50, 100 times or more on your money. And when you're not successful, you lose everything.
Right.
Now, that sounds pretty bad, but there's something called qualified business stock exemption, or QSBS, which says in the US, if you make certain types of investments, which most angel investments are in certain types of companies and certain structures, there's lots of provisos, but 85% of our investments qualify for it. And you hold for 5 years, some of it for 3 years now, there's change in the rules, your federal capital gains tax rate is 0. So if you have a fund you commit $100 to, and you get returned $300, those $300 might be tax-free, plus maybe only 25% of the portfolio worked and 75% went to zero. The 75% goes to zero gives you tax losses. So your after-tax returns are much higher than your pre-tax returns. And these returns generally are not correlated to the public markets. So early stage venture is putting together a basket of diversified alpha. For people who are tax paying, it's very tax advantaged. For institutions who are not tax paying, it's not tax advantaged, but it's not correlated to anything else they do. And if, under portfolio theory, having uncorrelated basket of alpha is very enhancing to overall return. So that's for the sophisticated institutional investor. And for the sophisticated non-institutional investor, there's all this tax advantage that can come along the way. And there are
That's
very few
amazing.
places you can put, $1 million to work and make 100 million.
Yeah. I
Right?
mean, those types of return, I mean, like you mentioned, I feel like those types of return are only met with the inherent risk of that upside. Um, but really that's super interesting about the tax savings and I had no idea that you could get tax-free returns even on personal funds. We have a lot of investors who, as we discussed, are using retirement capital to invest in
So
alternative assets in
it's
private
already
markets.
tax-free capital. Right. So in
Hmm.
which case the QSBS is not necessarily beneficial in that situation.
But still, the good thing about retirement and kind of to touch on something that you mentioned earlier is these are funds that you're tying up for, as you said, 5, 10 years. So, I mean, a lot of people, their retirement funds are already tied up. These are already funds that have rules and regulations on when you can touch these funds, when these can be pulled out. So I feel like a lot of the time, retirement capital is is patient money, right? Where
Correct.
you are looking for more of these
No,
investments.
absolutely, it's patient money. But this allows you with. So the interesting thing is, if you are as an individual going to invest in venture, you don't buy one fund and sit back. You want to buy a series of funds over time. So ladder your investment. In the early years, you'll have taxable losses that you can use elsewhere against your portfolio. In the later years, you should have non-taxable profits or predominantly non-taxable profits. And so that as a structure is tax efficient outside of retirement.
Right.
But I understand, this has to be part of your balance sheet that you're going to say, number one, could go to zero because you never know. And number two, it's, I don't need the liquidity.
Right.
Because once we make an investment, the only way we get money back is when the company sells or maybe someone buys the shares from us. Usually they want to buy them at a discount, and usually there isn't a market for them to be bought. And so it's really on exit, and exits happen through cycles like 19, 20, 21, good exit years, 22, 23, 24, dearth of exits. Exits started coming back in 25 and 26, and I think 27, 28 will be good for exits, but there is cyclicality with regard to exits.
Interesting. So is there a way to, I mean, I know they say don't time the market, but it sounds like there's almost a way that you have to in venture.
You want to have a manager who understands how the exits can work and how
Mm.
proactively they can try and manage it. But a lot of it's outside your control. That being said, if you're going to be in an investment for 10 years, you're probably going to go through two recessions and two stock market crashes anyway in the interim. So, so why put money to work in this space?
Mm.
Because we're in the middle of this long boom. And I would have said 20 years ago, I could see 20 years of this long boom, long growth cycle of technology. And honestly, 20 years later, there's another 20 years. I mean, it's like the amount of growth in tech. is enormous. And what we're seeing right here, right now, not only is the intersection of some very interesting technologies, AI with 3D printing, some advances in quantum that might actually make it useful. We'll see. It's still very experimental. Um, God forbid blockchain becomes useful. It's great for trading for sure, and but we've not really seen functional blockchain companies other than microfinance, cross-border transactions. Um, and there are places for it, like stable coins are really a great way to get people to buy US dollars without having to buy paper currency abroad.
Mm-hmm.
Um, so, there's lots of dynamics there, but you've got a whole series of technologies coming together. Plus, the efficiencies we're seeing from LLM driven technologies are enabling companies now to be much more efficient than before. They can grow faster with smaller teams. And so the business models are much more profitable. The companies are worth a lot more. We have a company growing 50, 55%, 450 people. They'll probably be able to grow at that rate and only add 50 more people rather than adding 150 people, which they would have had to do before all the efficiencies come from what we call AI point solutions or APEs
Yeah.
that companies can deploy to grow faster without adding headcount. It's a really fascinating point in where we are in technology, and I think that these growth drivers are going to continue to happen. I think that smaller companies can adopt them faster, and I think there is enormous amounts of money to be made in backing small startups.
Oh, for sure. And I'm a big fan and have always been a really big fan of new emerging technology. My dad, growing up, I always was watching him build computers, and he would be teaching me about the things that are upcoming in tech. And so it's something that I've always wondered, when you're in this position, you're identifying these new tech solutions. I feel like on paper in emerging tech, a lot of these solutions sound revolutionary, right? When you're putting the idea on paper, when people are pitching you their startup, when founders are coming to you, uh, I imagine a lot of these ideas, a lot of these solutions sound, like I said, revolutionary. When do you say no? Where does your experience come in, and how to sort out the right companies for the fund, when there's there's so much that AI can do. There's so much that can be possible, as you mentioned, with quantum computing becoming more realized. Is it is it like revenue metrics or market signals, or do you just have this gut feeling of, no, this guy, this company, they have a solution? What does that look like?
In the earlier stages, it very much is gut. It's very qualitative versus quantitative. And it's really trying to think what the world might look like 5 years from now and whether this company over that period of time can build barriers to entry to what they're doing. And, you know, it does come from experience and you can get it wrong a lot of time. But let me give you an
Sure.
example. There's about 3,000 companies a year backed by VC. There's about probably 30 to 50,000 looking for money. Okay? So every year, a large number of companies look up. If you look in the public markets, about 3,000 public market companies. All right? Let's just take one, Amazon.
Mhm.
All right? Who went and bought Amazon in 2003 when it was $3 a share? Right?
Some
Who
really
then
fortunate
it
people.
trade? I mean, but just take it. It traded up. Who sold it there, shorted it, it went down. Who bought it, etc. Like, and so in venture, you're going to miss a lot of stuff. The anti-portfolio is strong. You
Mm.
just don't know. And also between a company being formed and a company going public or exiting, a lot of things can happen. And things can be going great, and then they can trip over their shoelace and you exit badly, and suddenly you're an idiot. Or it can be an absolute disaster, and then they exit incredibly well for some reason, and then you're a genius. So there's a lot of idiosyncratic behavior around all this. I'll give you an example of a company we like a lot. We invested in a company called Manna. Manna is in the last mile drone delivery business. We led the seed round 6 years ago. We committed it before the company was even formed because I really liked the CEO and what he was doing. And, there was enormous hurdles to go over. When I first met with him, we sat down for like 40 minutes and he said, told me everything. I said, I've got one problem. He goes, what's your problem? I said, I don't know if you can build the drones. I don't know if they're going to fall out the sky and kill people. I don't know if they're going to be too noisy. I don't know if consumers are going to adopt. I don't know if business is going to adopt. I don't know if you can do it profitably. I don't know if the FAA or the European regulators are going to approve it. And he goes, whoa, you said you had one problem. Yeah. I go, my problem is I think you're the person to solve all these problems. And so I think we have to back you. And so, this is a company now that's done over 250,000 in production flights. It's 6 years later. They're up and running in Helsinki and Dublin. They'll be expanding to many markets over the next year or so. They're as far as I know, the only contribution margin positive company in the space, which means they make money on every flight. You'll be surprised how many companies lose money on every flight, but are trying to make it up with volume. They're trying to be car companies. And it's a business model dynamic that enables them to be contribution margin positive. But if you think about food delivery today, it takes about 28 minutes for your pizza or burrito or burger to be delivered to you. It's often soggy and a little cold because of that. You've had to put someone in a car on a road in traffic to get to you. And it costs them between $8 to $12 to do that delivery. Drone delivery at scale is sub 3 minutes and $1 delivery. So it's 10 times better than 1/10 the price and has a net promoter score better than Apple. People love it. And today it's sub $4 because we're not at scale. But at scale, you can get it from 4 down to 1. So it's highly compelling. And if the cost of delivery is 1, obviously you have to charge a profit. But if it's $2 or $3 or $4 the consumer pays, as opposed to what they're paying today, $20 for their delivery, embedded either in the price or in explicitly or in tips and other stuff. You don't need tip a drone. Then demand goes up. And in fact, half of the deliveries that Manna does are things for like croissants and coffee and milkshakes because it's just so convenient.
Right.
Yeah, and it's kind of fascinating. I saw on Twitter someone said that they got a new tipping thing. They were asked to tip for pizza, not just the person delivering it, but the person making it. He's like, now I've got to tip the whole supply chain.
Where does it end?
Yeah.
Yeah, hopefully it ends at drones. I'm not going to be tipping any drones, even
No,
if they
you're not
do
going to
deliver my
tip the
food in 3
drone.
minutes.
And so it's just this whole space is fascinating. And to me, when we backed it 6 years ago, I said in the future the sky will be filled with drones, and I think we're getting closer. They have a European beyond visual line of sight license, and they can roll out across Europe. US is a year or two behind. But this is a fascinating company, and the addressable market is tens of billions of dollars of revenue. It's just massive.
Wow.
So that's an example of something you want to back. It wasn't solving a problem 6 years ago. It's solving a problem that's in the future. The barriers to entry build, there's a little regulatory barrier. There's a design barrier for the drone. which needs to be highly customized and ties really into the business model. There's barriers because of agreements they have across the board, and there's a bit of a first mover advantage as well.
That's super interesting. So you've told us about, you know, this drone solution that is really exciting, and um maybe maybe if you have any opinion on this, um could you tell us about maybe the most overhyped AI or technology use case that you've heard or that you've seen going around today? We've talked about something that has real life implications. Is there anything out there that you've seen that it, people are talking about a lot or is really hyped up that in your opinion is not realistic?
So I think so. The answer is no, because I'm not going to talk about things we haven't invested in. And we haven't invested in things we feel are overhyped. But I think in AI, this tech stack is different than every prior one I've seen, and it's different because if you go back to like 98, 99, 97, whenever you understood the internet, and whenever you understood the internet, you basically understood it. Yeah. Sometime around about 96, I remember, I went to one of the technology leads at Goldman and said, why don't we use, rather than putting an application on client's desk, why don't we use it on our servers and have them come in through this thing called Mosaic, which was the first browser, and
Yeah.
before Netscape. Why don't you come into Mosaic and they could, do their reconciliation there rather than us building the application? The guy looked at me and said, we're talking about real business here. This internet is a plaything for you. So, but once you understood the internet, you had an advantage.
Right.
If you understand AI today, a week from now, you're completely lost. It's moving so fast that even if no more development happened, it would take 10, 15 years to permeate across industry. And yet this week it's Claudebot, right? And should we all be, buying our Mac Minis and installing Claudebot and giving it access to our life and being our personal Jarvis, right? I don't know. We'll see. So there's so much stuff going on. So what you don't know is which layer is being commoditized first and where the value will be. There's all different layers in AI, and I'll give you two examples. One is OpenAI. I'm concerned OpenAI will go bankrupt.
Who?
The biggest signal for me is OpenAI has said that they want to be paid a percentage of the ROI on anything they enable. Because they
Any
realize
efficiency they
the
enable?
value is in the application,
Mm-hmm.
not in what they're doing, and they want to capture some of that. Well, I don't mean that's achievable. There's too many open models out there. They don't really have the ability to extract that. But that's them saying we're not the most valuable part of the stack. So I think that's fascinating. I think they're burning cash hand over fist. And if they can't raise the capital, I just don't know what happens. So I think that's interesting.
Mm-hmm.
I also think it's interesting what Apple's doing. Apple is saying the value in the stack is not in owning the model. We'll actually let Google own the model. We might even run on Google servers. We don't really care. The value to stack is the presentation layer, and us simply having really good phones that do really useful stuff, have their Jarvis built in, as it were. So, yeah, I think that's interesting. And then the other one is a lot of people on Zoom and Teams and Google Meet, and they'll have an AI come in and transcribe the meeting.
Right. Like a
And
note
you
taker.
think, isn't that commoditized? And the answer is, at some level, it is. Yet, one of the companies 6 months ago raised money at $1 billion valuation. So obviously the investors behind that said this is not going to be commoditized. And, in the startup community, granola is the leading one. And why? Because they've built really good workflows around it. And those workflows help it integrate naturally into what people want to do. And because of that, it seems to be the leading one today. And if it continues to be the case, then maybe it isn't the commoditized part of the layer. But when you're a VC, you're trying to invest for 5-10 years forward, and this is a space that's difficult to see 5-10 weeks forward in where things are. So you want to invest in the non-commoditized layer, the part of the layer that you can build barriers to entry around. And so I think it's truly, truly fascinating. Again, if you want exposure to last mile drone delivery, it's going to be embedded in Amazon. It's embedded in Google. They have something called Wing. Or you can go to the private markets, but you can't really get exposure in the public markets. Right? And by the time you do, it should be a $10 billion plus company. And so you've missed out on the 0 to 10 billion part of it.
Right. That's so interesting. And I love how you break it down between, where these companies are placing the value on AI. That's super insightful. And that's interesting how you say Apple's saying, look, it's where it sits in the stack is not in this large language model we're providing for you. It's in the interface, it's in the user experience, it's in how it interfaces with society. That's super
Well, I mean,
fascinating.
but think about, look, listen, Apple sells phones and other devices,
Yeah.
computers and like. The iPhone never says we have 37 levels of AI embedded and stuff, or 100 levels, or whatever all the AI is. They just say we take nice photos, right?
Right.
Right? They don't
Yeah.
say, to the consumer, they really don't say our chip is faster than that chip is, I mean, it is and stuff. But they only talk in terms of what it enables. You can see, they only brought out low light pictures and low light video when it just worked, when it didn't drop frames, etc. So they're selling functionality and usability that happens to use a ton of AI. But if you don't watch their keynotes, you go in their stores, they generally have shied away from it. That being said, they tried to lead on this AI, Apple Intelligence thing, which really fell on its face because the underlying tech wasn't there. And there's other reasons related to that. But still, generally, right, they're selling on capability. And I think as a consumer, you want capability. If you buy a Tesla because it's self-driving, right, you're not really saying, well, is their AI model better than the AI model that Mercedes is using? You're just like, does it functionally work? Does it take me from
Which
my
one can
driveway
take
to the
me? Yeah.
parking lot and I don't need to touch the steering wheel, right?
Mm.
And if you go and get a Mercedes and it does the same function, you don't really care how it does it. You don't care if it uses LiDAR or if it uses radar, if it only uses cameras. You just functionally want to get from A to B without touching the steering wheel or the pedals, right? So,
Yeah.
it's that end functionality which really delivers it.
John, this has been incredibly insightful. Um, for listeners who want to better understand early stage investing or follow what you've been building at FFVC, hear more from you, where can they go? How can they get in contact with you?
So, if you go to our website, ffvc.com, you'll find a link to our newsletter. Newsletter goes out twice a month, goes to about 25,000 people. So, and we push out what we call Gives, Ask, and News. It's our GAN newsletter. Things you want to give community, things you want to ask community, and relevant news. So that's one way to stay sort of within our community. I'm on Twitter at John_Frankel. You can follow, some of my thoughts there. And then, my general sense is there is so much happening in tech. We've gone through the period where we said software's eating the world. Now AI is eating software. I'm an AI optimist, so I think there'll be more jobs in the future, not less jobs. There'll be more opportunity, not less. And I think it's a very exciting, particularly in the US economy, which I think is tuned to lean in to these drivers that we have here. Um, so I think it's a really exciting time, all in all.
Yeah, absolutely. I would 100% agree. I'm really excited to see where this next technological boom takes us. I think we're really still in that early stage of it being adopted in society and us kind of realizing how it's going to integrate into society. I really appreciate your time today, sharing your valuable insights and your insider knowledge on these markets, on these companies. Any last words of wisdom for us, your favorite quote, anything to leave the listeners with before we turn it off here.
Gosh, I just want to reiterate. I think we are at an exciting time for technology development. I think in the US we have administration and a mindset that's leaning into this, and I think there will be tremendous number of opportunities. We see a lot of rejuvenation of energy and manufacturing sectors in the U.S. We think it's a really exciting time for people to start businesses, back businesses, and we think the opportunities are everywhere.
Absolutely, I 100% agree, everybody. John Frankel, go check out FF Venture Capital, ffvc.com. Like he said, go check out their newsletter if you want to stay in the loop, if you want to stay embedded in that community and hear the latest of what's going on. Great opportunity there. Follow them on LinkedIn, Twitter, X, whatever you want to call it today. John, really grateful for your time, and we'll see you all next time. Thanks, everyone.
Thank you, Nick. Bye.
Absolutely. See ya.